Hey guys, Spencer Powell here with Growth Mode, where we are all a work in progress. In today's video, I want to talk about what a cash out refinance is, and then I'm going to walk you through a case study so you can see the exact numbers, how I decided what I wanted to do with my property, how the numbers shook out, and then you can take that information and apply it to your own situation. Let's dive in. All right, so let's talk about what a cash out refinance is and then what some primary goals are when you typically do this, and then we'll move over to the case study. Before we get too far, don't forget to hit subscribe and then hit the like button if you are enjoying this content. And then also, please share this with a friend if you think it would be helpful to them. All right, so let's get started. Typical goals for a cash out refi. So the first one is we want to extract tax-free dollars. So this is my favorite part, which is if you have a property and it's appreciated, you have some equity in it, right? So maybe you bought it for 200,000 and it's gone up to 300,000 and you've paid it down to 150, you have $150,000 in equity. And then if you sell it, then you typically have a number of costs associated with that. So one is you're going to pay closing costs, realtor fees, typically about 10% of the purchase price will just go to that. So if you have a $300,000 home, $30,000 just gone from the transaction. And then if this is not your primary residence and it's an investment property, you're going to have capital gains that you're going to pay on this. And so you're going to pay tax on any gain. So 200 to 300, that's $100,000 gain in equity. So you're going to pay taxes on that. So you just lose a lot of money during that transaction of the sale. If it is your primary residence, then you're actually exempt from capital gains up to a limit. And it's a pretty substantial limit. So if that's the case, then you're just looking at those transaction fees. So in this case, I have a rental property. And so I definitely was looking at selling and maybe doing a 1031, but I really didn't like the idea of basically just giving up a lot of my equity to closing costs. So I liked the idea of using this, getting those dollars out tax-free, and then not having to pay the transaction fees. A secondary goal is lowering the interest rate. So we'll talk about that a little bit. And then a third goal is that sometimes you can actually improve your cash flow. A lot of times you actually won't be doing a cash out refi to improve your cash flow. A lot of times that will just be a normal refinance of a property. Maybe you're lowering the rate or extending the timeline. And we can talk about those in some future videos. But you still might be able to improve your cash flow. And as you'll see in this case study, I did not. It actually got a little bit worse, but there were some other benefits that outweighed that. So I'll walk you through those. All right, so with that in mind, those are some typical goals on why you might want to consider a cash out refinance. And let's dive into the case study here. So we'll start over here with the current scenario. So first things first, I bought this property for $142,000, and then it has gone up over time to $325,000. No, this wasn't over 2 or 3 years. This is about an 11-year time span. So it has more than doubled, but it's also been quite a few years since then. So $325,000 in terms of the value. I've paid it down to about $77,000 in terms of what's remaining on that mortgage. So if you subtract the two, you have about $250,000 in equity just sitting in the property. So that's that piece of it. My payment on this is $510 a month. And then I have an interest rate of 4.5%. So that's the scenario I was looking at. I was going, okay, do I want to sell this property and maybe buy 2 properties using a 1031 exchange? Or maybe I can do a cash out refi and just extract some equity and then buy 1 more property. And now I've basically turned 1 into 2 using that same equity. So those were some things that I was considering in this situation. So I ended up going the cash out refi route. So we'll move over here. So we've still got that property worth $325,000, and now I've added to my mortgage because I'm basically saying, hey, give me a new 30-year loan, and I'll go to the bank and say, I've got this one that's 77, and then the bank will say, okay, now you want to pull out 40, plus we're going to charge you some closing costs and some fees and all that good stuff. So it's about $5,000 to do all that. So that's why if you subtract these two, it's more than $40,000. And then they roll all of that into a new loan over 30 years. And now I have debt of $122,000. So I've still got about $200,000 in equity in the property. And I'm pulling out $40,000 in cash. And then they just roll those fees into the loan. So I'm not actually paying for those out of pocket, which is nice. So no cash out of the pocket. And now I have a new payment and a new interest rate. So I was able to get a 3.875 rate. That's an investment property rate. So if this was going to be my primary residence, it would be much lower than that. And then the payment went up. So you'll see it was 510. Now it's almost 710. So this is kind of the end result here. 40,000 cash in the pocket, which is nice. And then we've got a cash flow change. So now on a monthly basis, I'm actually making $198 less than I was before. For this particular property, I rented out for about $1,500, and then after my expenses, basically it cash flows around $600 a month. So now it's going to cash flow about $400 a month. So my net change was about minus $2,400, and now I've got this $40,000. So that begs the question, okay, now what are we going to do with the 40,000? Really, the money is yours. It's tax-free. You can do whatever you want. You could go buy a new car, buy a boat, go shopping, blow it. Obviously, that's not the goal. The long-term goal is to take this and recycle that money and go use it to make more money. So we've got a few different options that we could do. So if we come over here to next steps, we could put it into more real estate. We could put it into stocks. We could do something else with it. If we wanted to use this for stocks, I just walked through a quick example here. Let's say we just plopped it into an index fund. Typically, that's going to return about 10% over the long haul. So that would be $4,000 in that first year. And so if we compare that to right here, that was, hey, minus 2,400 on our cash flow for that year, but we actually made 4,000 over here. So our differential was $1,600 for that year. So we actually came out ahead by taking that money. And even though we're borrowing more and we're basically decreasing our cash flow, then we put it to work harder at a better rate of 10%, and we came out ahead. So that's a sweet deal, right? But as you guys know, I like the real estate route. So let's walk through an example here. So let's say that was going to be your 20% down payment. You're just going to go the traditional route, save up 20%, put it as a down payment on an investment property. That would put you at a $200,000 purchase price. That may or may not be possible depending on your market. If you wanted to find something at $200,000 right now, you'd probably have to go out to the Midwest or some of those central states, and you might be able to find something in that price range. And in your market, that may not actually be possible. So for the purpose of this case study, we'll walk through what that would look like if that was your down payment. You would buy something at $200,000. And then we're going to look at, okay, in year one, what is this $40,000 investment going to yield? And so if we take 4% on the $200,000, because that's the asset we control now, and 4% is typically what real estate appreciates at every single year over the long haul, then that is $8,000. So this would be worth $208,000 at the end of the first year. We're also going to pay down principal. So that property has a mortgage of $160,000, and we're going to be paying that down over time. So in year one, we pay off about $2,800. And then I just did a conservative estimate and figured, hey, if you're renting this out, about $100 a month cash flow, you might be able to do a little bit better than that, but we'll just be conservative and say, hey, you're cash flowing about that. So if we take 8,000, 2,760, and then 1,200 a year, so 100 times 12 months in a year, this is your total return in terms of dollars. So about 12,000, which is a 30% return on that 40,000 invested. And so obviously, if we compare this to what we lost out in cash flow over here, we're coming out way ahead. And that ends up being a really nice multiple in terms of our, return there. So our net cash flow is actually going to look a little bit better, because this one cash flow is $100 a month, which is $1,200 a year. Over here, we lost $2,376, about $2,400. So if we take that and add that, this is actually our net cash flow across both of these properties now. So just about $1,200 a year that we're down. But obviously, we've appreciated $8,000. We've paid down our principal. So we're coming out way ahead in terms of growth here. The other thing I want to highlight about this, which is really powerful, is that one, we kept this property. So we're holding onto our asset and we're just taking some equity out and then going and having it work harder for us. So this will continue to appreciate. We didn't have to sell it. We didn't have to ditch it in any way. So that's a really positive note. And then rents appreciate over time. And in this specific example, I've actually got renters that are in the middle of a 2-year lease. And based on where rents are at today, when that lease comes up in about 7 months or 8 months or so, I can actually raise the rents by about $200. So either they'll renew at the higher rate or I'll go find some new renters. And so this, I will actually just totally eliminate the increase in payment here. So it'll be about a year that I have that $2,400 less in cash flow. And then in a year, I'll bring it right back up because I'll be able to raise my rents with my new payment. And then I'm basically looking at taking that $40,000 and it pretty much isn't costing me anything. And then I can take that and again, use that over here, whether that is stocks, more real estate, or shoot, you could even throw it into some stable coins over an account like BlockFi or something like that and earn 7 to 8% depending on where their rates are. And that could be a good option if you're looking at actually saving up for another property, because 40,000 maybe not enough to put a 20% down payment in too many places. So you might need 50, 60, or 70. So while you're saving up, you could take that and put it into something that's going to earn you maybe 7 or 8%, but maybe isn't as volatile as the stock market. So that is what I did. One more note on this is I actually considered taking out 80,000 because I have enough equity in this property, and I could have done that, but that would have bumped this payment up a couple more $100 than the 708, and I just didn't want to cut my cash flow into that property, and so I decided, let's just take some out, and then within a year, this will pretty much stabilize at the current cash flow. I like that situation, and now I can take that 40 and go do something else. So hopefully this example helped in terms of outlining what a cash out refinance is, how you can use one, and then hopefully you can take this and apply it to your situation. And with that, I will just say, please pass this along to a friend, hit the subscribe button. I don't have any courses to sell, just trying to pass along financial education so that we can all get a little bit better and create financial freedom in our lives. All right, guys, see you next time on Growth Mode.